Fundamentally, there are a few key principles that have to be applied to determine a venture's net present value and whether it is positive or negative, and ultimately whether the company should execute or not execute this particular venture. Let's do a very simplistic example which demonstrates a template. It demonstrates a template of how you go about this. So in the example we're looking at, let's say we are doing a mining project, and that mining project has got a life of 3 years. Let's call it life of mine. We have to invest 10 million into that project today, and that's in year 0. So that 10 million from an investor perspective is a cash outflow. In terms of the cash flows this mine is going to generate, in year 1, it's going to generate positive cash flows of 3 million. In year 2, positive cash flows of 5 million. In year 3, positive cash flows of 5 million. That will be the end of life of that mine. So at the end of year 3, we'll also be able to dispose of the assets and generate an additional 2 million. So the net cash flows over the years from year 0 to year 3 are a negative 10 million, a positive 3 million, a positive 5 million, and a positive 7 million. Now, I've given you the discount rate you need to apply to this mine. It is 25%. What you need to do is to apply that discount rate and come to some present value factors. So if the discount rate is 25%, the PV factor in year 0 is 1. Paying out 10 million now is worth paying out 10 million. The PV factor in year 1 is 0.8. The PV factor using your present value tables in year 2 is 0.64. And the PV factor in year 3 is 0.512. If we apply those PV factors, if we apply them to our net cash flows, we get a present value in terms of the cash flows of a negative 10 million in year 0, a positive 2.4 million in year 1, a positive 3.2 in year 2, and a positive 3.584 in year 3. Now, if we add up all those present valued cash flows, we get an answer of a negative 0.816. We get a negative net present value. What is this telling us? So this process of capital budgeting using net present values allows us to make a decision as to whether to proceed making a significant investment in the project or not proceed before we spent a lot of money. It's a decision-making tool that should enable a much more disciplined capital allocation approach. Now, one of the easiest ways I see in a business to undermine this tool is when the managers start to manipulate the discount rate. So in the early example, we applied a discount rate of 25%, and the net present value of the venture was negative. If this was a fair reflection of the project's prospects, a company would ordinarily not invest in such a project. It had a negative NPV. But frequently, executives, managers, and other decision makers want to do the project for other reasons, regardless of what the capital budgeting model is telling them. So they manipulate or justify a lower discount rate of, let's say, bringing it down to 18%. And voila, the venture suddenly has a positive NPV. What these executives are doing is that they are actually destroying value in the business. Whilst the lower discount rate justifies the project through a positive NPV, in reality, the project is not generating enough returns to cover its cost of capital and the related risks. Be careful, guys. They're going to destroy and kill your company. And to avoid this, many companies have what are called hurdle rates. This is a minimum discount rate that has to be applied in the evaluation of all projects or all ventures using NPVs. Now, we'll take a better look at these more when we look at hurdle rates in the weighted average cost of capital section. But it's important to note for the time being that hurdle rates help reduce the likelihood of the discount rate being manipulated in order to qualify projects that ordinarily would not qualify.